and welcome to this special edition of the India Growth Mission. I'm Tamanna Inamdar. For investors, the last couple of years has been perhaps like none other, especially those who decided to invest in equity. We had massive returns. But is that tide changing? World over, we've now entered a phase where growth is getting tapered down, growth is tempered, and interest rates are rising. Now, the question is, how does one invest and save when you've entered the higher interest rate cycle? Because on the one hand, if you have loans, you're possibly going to be paying a little more for them in terms of the interest you pay. And on the other hand, some of your savings may not improve as much as they could. So what is the best way to navigate these tricky waters as a saver, as an investor, and as someone who's paying off loans? To speak on this, I'm joined today by PV Subramanyam. He's CEO of www.subramani.com. Harshvardhan Roongta is with us today. He's CFP of Roongta Securities. And Adil Shetty, CEO and co-founder of bankbazaar.com, is also joining us on the show. Welcome to all of you, and thank you so much for speaking with us today. Mr. Roongta, let me begin with your situation. Would it be with your take on the situation, would it be a fair assessment to say that the landscape for investors / savers has changed dramatically in the last 6 to 8 months? You've had the COVID impact sort of fading on the economy, but then you have now geopolitical factors and interest rate, inflation, all of that now coming together. Is it time to rethink where your money is?
Absolutely right, Tamanna. In fact, if you've looked at the impact of all the geopolitical situations, the economic conditions, the RBI policies, if you look at all this on the investor, I mean, it has been a tough year for the investor, at least in the last 1 year. Now, when I say tough, I don't mean that markets have not given you returns. No, that's not what I'm trying to indicate. When you look at an investor's portfolio, you will notice that there has been an impact on cash flow. So while during the COVID situation that we're looking at the lockdowns, we had seen cash flows being impacted of many people. I mean, you had job losses, you had pay cuts, you had all those kind of situations. So while an individual was dealing with that, you would find turbulence in the market with regards to his or her savings. So when they were invested in equities and when they needed money, markets were down and they could not withdraw at that point in time. Now the situation that we see is that interest rates are going up. And so are the loans, the rates for the loans are going up. So now you will see the impact again coming over all those people who borrowed money, and their EMIs will start going up. So yes, there has been a difficult situation in all these circumstances. What is important is that if an investor has made his financial plan and allocated money towards all possibilities, then possibly they were able to manage situations better. So they had emergency funds, for example. So, they sailed through the lockdown. If they had, planned their EMIs, prudently and not taken excessive loans, then even in a slight raise in interest rates will not impact the cash flows. The interest rates going up, EMI amount, the figures going up, but does not impact the cash flows per se. So yes, as an opening remark, yes, there has been an impact and continuous impact on individuals' cash flows. However, if adequate planning has gone through it, then possibly they have still managed it better than the others.
No, but that's fine. We're talking about people today who are now wondering what to do. Mr. Subramanyam, essentially the question right now is that if you are not someone who has the perfect financial plan at all times to sail through any kind of waters, what do you do right now? How do you make the most of the beginning of a high interest rate cycle?
Okay, Tamanna, the thing is, if a person has been a long-term investor and he's already invested and he's been investing for 30, 40 years, his reaction will be very different. But somebody who has been investing for last 2-3 years, maybe he's got 13% kind of a return. If he has a very big loan, he should repay that. Because of this K-shaped recovery, depending on each person, some companies have done well because of the lockdown. Some have done badly because of the lockdown. So if you have done well, obviously you're more confident, you're willing to take on more debt, you're willing to buy more assets. But if you have not gone through a good phase, you may now be downsizing. So it's a good time to get rid of some of your more volatile assets, maybe get rid of some of your mutual funds and equity and pay off the loan. But if you've got, say, 1 year or 2 years CTC as a loan and you've got good qualifications and you're not worried about your job, don't fret too much. Jumping from here to there will not really help. because interest rates may go up, but I don't see GSEC rates going beyond 8.5%. So, okay, we are there, maybe another 100 basis points. So that's okay. You should be able to manage it. If you have a good job, a good plan, you're able to repay. If you don't have that, then sell off some assets and pay off the loan. That's what you can do.
Okay, so number one is now protect yourself by paying off the loans. Mr. Shetty, do you agree with that assessment? That first pay off the loans and then think about whether, these high interest rate cycles are going to do anything for your savings?
Yes, I do agree. And let me just go a little bit into how this is going to work for home loan borrowers, Tamanna. So when the interest rate goes up, right, and like the previous speakers said, there's an expectation that the repo rate will rise 1 to 2% over the next 12 months. Time will tell. Automatically, what the bank does if you're an existing home loan borrower is that they don't increase your EMI, but they increase the tenor of your loan. So what ends up happening is the tenor of your loan goes from 20 years to 21 to 22. Essentially, you're paying more interest on that existing home loan. Now, the best way to combat this was, what was just said. If you can prepay, we advise that prepay 5% of your outstanding principal every year. Every prepayment you make goes in bringing back your tenor to a lower number. So while the interest rate or the repo rate increase will increase your tenor, every time you make a prepayment, your tenor will come down. Now, let me give you an example. If you have a 50 lakh loan over 20 years at 7%, if you pay one extra EMI every year, you'll save 14 EMIs at the end of your loan. So I would completely agree. At a time when FD rates are 5%, you're paying a third of that in tax. Inflation is at 7%. If you can prepay, this is be prepaying as home loan rates increase.
What about the other side of the story? Mr. Roongta, you think that even now the SIP mutual fund route is the best one for investors, or should they look at debt funds more carefully?
Well, Tamanna, investing into equities or debt will depend upon the requirement of the individual. So not relating to the interest rate cycle. Now, if a person was investing with an asset allocation of 70-30, for example, 70% going into equities and 30% going into debt, I don't see any reason to make those changes in the allocation purely because interest rates in the markets are going to go up. So a person's requirements will still be the same, just that you have to manage the liquidity that you have for short-term requirements. So that is where the interest rate movements will have an impact, not on your long-term goals. So for example, if there was a retired individual who was dependent entirely on interest income or some fixed return instrument where interest was the only source of income, then it's a point in time to look at investing those corpus that you have into assets which are going to likely benefit out of the rising interest rates as well. So a part of that corpus you will possibly look to park it today because of course the interest rates have gone up marginally already, and you will still keep yourself certain flexibility to, in case interest rate go up further, you should have the capital to invest and capture that increase in interest rate as well. So from a saver's point of view, which your question was, if you have a corpus in your hand and you're looking to deploy that and your allocation says that it was to go into debt products, then of course you can at this moment park probably 10 to 20% of that corpus, fix it at a interest rate today, keep the 80% available with you so that in case interest rates go up, you will again have an opportunity to park another 25-30% at that point in time. So you're doing nothing else, but you're trying to capture the interest rate rise and take the benefit of that. And you don't want to park everything today. What if interest rates go up by 100 basis points? So you want to keep a certain margin with yourself, which can be used later. So that is a strategy that probably an investor who's dependent on interest income will do and has a corpus. However, if there's a younger person who's saving for probably 20 years from now for possibly a retirement as a goal, I mean, you don't need to really make any changes to your systematic investment plan. Equity will remain the best asset class to generate wealth over long term. So you don't need to make changes for your long-term goals, but short-term goals, yes, you can do some bit of changes to take the benefit of the rising interest.
The problem with the equity, or I wouldn't say problem, the question mark has become that even as prices have come down, they're still very, very overvalued overall. The way that Indian equities have run up has made fresh entries a little prohibitive. And people are thinking about that right now. What's your view on that, Harshvardhan?
So, well, you're right, Tamanna. I mean, we've been talking about market valuations being stretched all the while. I mean, and the markets have recovered very, very sharply, post-COVID and post the economy opening up. That's exactly the reason you will enter into the market through a systematic investment plan. So, while you're doing an SIP, you're only investing a fraction of your total money that you would be investing otherwise. So, if you're entering the market at all market cycles, so today, if you're saying markets are overvalued, yes, I mean, it could be. So you're investing only a portion of your money, which is a monthly installment that you put in. Next month, again, you're putting in the same thing you will continue doing over a period of time. So markets will keep going up and down. And as an investor, because we don't know what is the correct level of valuation, you invest at every regular interval and you average your cost of acquisition over the number of years. So while it is impossible to gauge what is the right valuation, while it is impossible to time the market, the only formula that works for an investor is to invest through systematic investment plan.
All right. So stick to the straight and narrow. Don't get too worried about what's happening around you. But, Mr. Shetty, now what about widening your ambit of, the kind of investment products you look at? Because on the one hand, you have high interest rates, but you also have high inflation coming in. And that is a combo that is sometimes very deadly on your savings. Because if you peg them to the inflation rates, you find very often that, you are lagging behind. So, Adil Shetty, this question's for you. How do you deal with the current environment, high interest rates, high inflation?
So, Tamanna, I think Harsh actually captured it very nicely. I think if I was to summarize it in, just one pithy advice, it'd be don't panic. These things happen over multiple business cycles. I think we're planning our lives, our personal finance for the long run. The allocation between equity and debt, if you're saving for your daughter's education, if you're saving to buy a house and you're saving it in equity, it's fine. These index mutual funds go up and down, but the data clearly shows over an extended period of time, you get the best returns, right, on equity and on index, Sensex, Nifty mutual funds. I'd say the key takeaway, right, and again, this is what was just covered, is that have the flexibility for whatever you do in debt, that as the rates increase, you can take the benefits. So, for example, let's say I had the option of signing up for a 1-year FD today at 5%. I probably would think twice, right? Because I know that in the next 1 year, rates are going to go up 1 to 2%. So I'd probably take a liquid mutual fund, wait for the rates to go up before I lock it in for a longer period of time. So whatever you're doing on the debt side, maintain that allocation, but have the flexibility that if rates increase, you can get the benefit from the same. But my main advice, right, is don't panic. If you're saving for the long term, if you have equity investments, continue your SIPs and just consider that, we have different pieces of our life, right? So your emergency fund needs to continue to exist. You might need it. Your saving for your daughter's education needs to continue to exist. And, you continue to manage all these various facets.
How long do you think the cycle is going to be, Mr. Subramanyam? When, it's fairly unpredictable now, but you had a situation last year when the Fed was calling the high inflation situation transitory, and it's definitely not transitory right now. You know that central banks all over the world will have to look at an increase in interest rates over time, and ours will too. So how long do you think this cycle is, and how can people plan for it?
I don't even know whether the cycle has started. There are two men pulling it in different directions. One Mr. COVID and one Mr. Putin. Are you trying to tell me if there is a COVID rerun happening in, say, US, interest rates will go up? No, interest rates going up will be postponed by 2 years. It's almost impossible to predict beyond 1 quarter what the Fed is going to do or what RBI is going to do. None of the governments have the heart to tell the people that you have to work hard, earn money, because they'll start sending out those $600 checks and the equity markets will again go up. We are very difficult times. We have always been through such difficult times, and I don't know whether I'm so confident that interest rates will go up. I do not know how much and how fast, right? So these two things are worrisome. And remember one thing, When interest rates go up, equity returns goes up in a slightly longer run. Takes a little time. So I would not be too much worried about 100 pips increase in interest rate. One, yes, like I said, if you're not sure about your income coming in, then yes, you have to be prepared for it. You have to say how will you repay the loan. But otherwise, I wouldn't even bother repaying the loans. I would continue to put money in equity. If equity market goes down in the longer run, my averaging will help. And at some stage in the future, when equity markets are giving some 30% return 1 year, I will take the money and repay the loan. So I wouldn't get too excited about interest rate changes, because interest rate changes, I have been, okay, let me tell you, I have been doing a SIP in a debt fund, which is a debt fund. And I'm sure when interest rates go up, I'll go and put a lump sum into it, because I don't know how interest rates are going to behave. I'm doing a small SIP in a debt fund and gilt fund and hold it. I'm getting something like 9% CAGR with the last 6-7 years. Now that is the kind of return which you can get. But yes, I can always remove money from that. So a little bit of an SIP in a debt fund without being sure when the interest rate will go up and how much it will go up. You talk to fund managers and you can draw a blank. Pretty dicey situation. So I wouldn't worry too much. I would look at my personal situation and adjust rather than worry about what the Fed and RBI will do. You have no clue what they will do. There are too many of them around the world who have no clue what they will do.
Exactly. Now, Harshvardhan, Roongta, let me also expand this beyond debt funds. And of course, we've spoken about debt products. But what about the favorites of Indian savers, real estate and gold? Do they shine a little more brightly right now in this scenario?
Tamanna, with respect to gold and real estate, I mean, when a person invests into these two products, it's essentially to do with satisfying an emotional need. It's real estate is a sense of pride in the Indian community. So when you have property, and if you're young enough, you made a property for yourself, it says, this person has made his property, isne apna ghar bana liya, that kind of thing. So, let's keep all the rationale of investing out of these two products. Now, with regards to whether gold will outshine, well, gold traditionally has been a hedge against inflation. So gold is expected, if I may say so, gold is expected to give you returns in line with inflation rate. So if you believe that inflation is going to go up and gold hasn't caught up to that, then there is a huge scope for gains to be made in gold. With regards to real estate, well, it's a very polarized product. I mean, you may not generically say that real estate in Mumbai will do well or Delhi, etc. There are different pockets in which the real estate will do better because of infrastructure developments in those pockets itself specifically. Coming to how people should deal with real estate and if they have taken loans, I mean, what we've been advising our clients now of lately since the last 2 quarters is that, figure out what is the rate of interest that you're paying on your loan. So invariably, it will be in the range of about the 7% plus minus. And if you do not have adequate, opportunities to deploy your money, so you have a fixed income asset allocation as an allocation, a fixed income allocation of about, say, 10 lakh of 20 or 30 lakhs of rupees, and you don't really have much requirement of that. What we are going ahead and now doing in certain cases is advising them to part prepay their loan, reduce the EMI, the burden that you have, and switch that EMI that you are paying towards an SIP, so that you can take the advantage of reducing your loan outstanding at a time when interest rates are expected to go up, and the EMI that you save as a result of that, you redirect that into growth assets, which is through SIP into equities or go into a hybrid kind of a product. So clearly speaking, until 6 months ago, debt was a very, very poor asset to be in because it was not beating inflation and actually reducing the purchasing power of the money. So now I think there has to be some kind of a rejig done, because your question started off with what should borrowers do and with a rising interest rate. I think this is one strategy that you will have to very actively consider to pay off your loans, use the EMI for some other investments.
Yeah, that's an interesting aspect. Adil, you want to come in on that formula that Harshvardhan has spoken about? That, redeploy the money now in ways that it will work better for you.
Yeah, I want to cover a couple of points here, and I think this is important. And let's talk about existing home loan borrowers and let's talk about new home loan borrowers. I think for existing home loan borrowers, there was a report the RBI put out about 12 months ago. 60-70% of people are still on the BPLR/base rate regime. I think everyone needs to run a quick calculation saying that today all loans are on a repo rate. If I switch my home loan, right, can I get a better deal? Like Harsh said, we see rates today in that 6.7%, 6.8% range. So if you're paying today 7.5%, there's a genuine opportunity that before the repo rate starts increasing, that you can see if you can refinance either with the existing bank or with a new bank. Now, for a new home loan borrower, right? Let's take a example of someone who's taking a 50 lakh loan. If you take a 50 lakh 20-year loan at 6.7%, you're paying something like 38,000 rupees, right? Now, be aware that every 1% increase in the repo, and time will tell what happens, you're going to end up paying 3,000 rupees more in terms of your outgoing EMI. So I think if you're a new borrower, right, the advice we're giving people at Bank Bazaar is maintain a great credit score. Today, all discounts are built into having a credit score over 750, right? If you have a credit score over 750, 800, every bank is saying, I'll give you, 0.1% off, 0.2% off. So if you're a new borrower, this is a time to build a good credit score, ensure you have no outstanding issues with any of your debt lines, and start getting ready that, you might have to cough up 3,000 more for every 1% that the repo rate goes up.
Absolutely. So a lot to mull over, a lot to think over right now. Definitely, if you've done already a fabulous job of, deploying your savings, then perhaps you have nothing to worry about. But for most of us, that's not always the case. So maybe it's time to relook at where your money is going, what are the kind of loans that you're paying, and how to make the most of what is clearly looking like a rising interest rate cycle. Thank you so much to all of you for joining us on the show today.
Thank you.